Hello friends, are you a day trader with a pure intention of getting in and getting out in the same trading session? And are you also noticing how the prices nowadays very often are opening with a gap up or a gap down nowadays? And that's making trading a lot more difficult for you and me. If you're looking for a solution, this video is right for you. And in this video, I'm going to share my experience of 36 years of trading in this market to help you solve some of your trading problems. And this particular video is all about negotiating trades on a day where the price has opened with a gap up or gap down. Friends, I'm Vijay Bambwani, a professional trader. I run a prop trading company and I'm going to tell you how to deal with gaps. First and foremost, what are gaps? How are they caused and what is the underlying reason? As you can see on the chart on your screen, a gap is where the price either opens well above the yesterday's intraday high or close or below. If it's a gap up, it's called a bullish gap. If it's a gap down, it's called a bearish gap. You see, what has happened is either some news or emotion-based buying or selling, some act of God, some man-made action like war, etc. has occurred after the market closed yesterday, and today the market is reacting to that news. Sometimes, and nowadays that sometimes is getting a whole lot more often, there is also influence on the price. I would say manipulation by big money, smart money, algo traders, dark pool operators, etc. So this is causing a gap up and a gap down, and traders who've made up their mind to trade at open for a particular direction are forced to get into that trade at a very, very lousy price. And that is unfortunately resulting in a loss. So this is something that we need to address. Do gaps get filled all the time? Not necessarily. There are breakaway gaps that don't get filled for very, very long periods of time, sometimes ever. But sometimes the gaps do get filled. And as we progress further in this video, you're going to understand the difference why. But before I go further, since I practice what I call a 360-degree worldview, which also takes account of behavioral finance studies, I want to share a story with you which will make you help understand gaps better. This is about you trying to buy a used car. So you walk into a showroom, you like a particular car, and you ask for a quotation, and you're told that that car is available for 1 lakh rupees, 100,000 rupees. You like the car, but you keep a straight face. You don't want the salesman to know that you're eager to buy this car. Otherwise, he may not give you a discount. And with a straight face, you give a counter offer of 70,000 rupees. But the salesman in turn gives you a final offer of 90,000 rupees. You in turn give him an ultimatum. Either you take 85,000 rupees as my final offer or you leave it. I'm going to walk out of this showroom. The salesman appears anxious to close in a deal and therefore he caves in. You get your car, you feel great, you've just saved 15,000 rupees on a 100,000 rupee car, you feel very smart and you do all the paperwork, hand over the money. And then, when you're driving out of the showroom, on the showroom wall or on the road opposite, you see that exact car in an advertisement available for 65,000 rupees from that very showroom. At that point in time, you realize you've been made a fool. This is what gaps do. Now, you try to sell it back to the showroom, but you're offered only 55,000 rupees because the car was originally supposed to be sold at 65. So the showroom is offering you 55. If you try to sell the car, you're losing 30,000 rupees. And if you're keeping the car, you lose 20,000 rupees. What made it possible? What made it possible was that the salesman quoted 1 lakh rupees for a car that was actually supposed to be sold for 65,000 rupees. This is precisely what the operators, what the smart money does by opening prices with a gap up or gap down. They are forcing you, they are enticing you, they are making you succumb to temptation to get into the trade at a price not necessarily in your favor. Invariably, it is not in your favor. Now, why does it happen? What does behavioral science say about this event? And let me tell you about behavioral science. In this market, mass psychology, behavioral psychology works more than quantum physics, formula, mathematics, or even charting. Screen reading is also a form of behavioral science, behavioral finance, because you're reading the numbers on your screen and you're trying to make sense and sensibility out of it. So, what is at work here is a concept called anchoring. What that salesman did was he anchored or placed a price of 1 lakh rupees in your head. Now, being a buyer, you obviously want a discount. That is your right. But a discount on what? You started asking for a discount on 100,000 or 1 lakh rupees because that price is now anchored into your head. The fact that this car was actually worth 65,000 rupees escaped your attention, or you would have started from there. In a gap up or gap down, the opening price is where the operator is trying to anchor that price into your head. So when you're trying to put in a trade, you will not put in a trade based on what your trade setup, your entry or exit price levels were telling you beforehand that you had done in preparation for this trading session. Your mind is now tempted to review the entry and exit price based on the anchor price. Now, this is the first mistake. This is human weakness. This is greed. This is we trying to get into a trade where we should not be, and the operator is betting that you're going to bite the bait like a fish, and then he'll reel you in. Now, I've told you about what the problem is. Is there a solution? Hey, that's what I'm here for. You have problems, we find solutions. That's what my channel is for. And being a prop trader, being a real world trader, the real thing, I'm going to offer you solutions based on what a real world trader does, especially what I do. So now, solution number one, never enter a trade where that particular counter has already reached 1 ATR. ATR stands for average true range. Now, if you look up any free charting website like TradingView, Investing.com, ChartView, etc., you will see an oscillator called ATR, Average True Range. If you see that reading of 10 days or 12 days, that is exactly how much, or rather I would say approximately how much a stock is expected to move intraday. So if a stock is supposed to move, say, 6 rupees intraday as per the latest ATR reading, and the price has opened gap up and you had thought of buying, if the price has already opened gap up by 5 rupees 50 naya paise where the ATR is 6 rupees, is there any point in buying? The answer is no, because the ATR itself tells you that there is a maximum possible potential of 50 naya paise, and the downside is 5.5 rupees. So the risk reward ratio is not in your favor. If you've crossed 1 ATR, just avoid. Solution number two, you avoid the first 8 to 10 minutes. Now, this is something that I have covered especially in a video of 21st of April 2022. Avoid trading in these hours, or which are the best hours to trade. The hyperlink to this video is in the description below this video. It's in the pinned comment below this video, and the video itself will appear as an end screen in the present video. I've told you why you should and should not trade in certain timings of the day. And the first 10 minutes of the day are covered very extensively. So I'm going to tell you in brief, since that video is going to tell you in detail. Avoid the first 10 minutes and you should be fine. 50% of that problem is sorted out. Even if you were to enter after the first 10 minutes, the direction that the price opened in must hold very strongly. So, assuming you had decided to buy a stock A, the stock opens with a gap up. The gap up is not equal to 1 ATR, therefore you are tempted to buy. You also wait for the first 10 minutes cooling off period, and even after the 10-minute cooling off period, the price is not coming down significantly. Only then should you buy. So, patience is the key. Now, there is a video that I had shared with you about the Snapquote window. It's called the Millionaire Trading Blueprint, wherein I told you how the Snapquote window, which you can bring up by clicking on F5 on any counter, brings up the Snapquote or the best 5 quotation windows. There, if you're buying after the first 10 minutes of a cooling period, the LTQ or the last traded quote must trade sustainably above the average traded price, and in the case of a short, the last traded quote or the last traded price must trade sustainably below the average traded price. Unless it does so, avoid that trade. The hyperlink to that video is also in the pinned comment and in the end screen of this video. What happens if you initiate the trade because the conditions are met? The LTQ is above the ATP and therefore you go long, or the LTQ is staying above the ATP and therefore you go short. But what happens if after entering the trade that situation reverses? Hey, the trade is over. It's a mistake, it's a bad trade, it's a lemon, it's a sucker. Just come out of it. Now, solution number 6. If the gap was made possible at open on poor volumes and poor open interest expansion, and the follow-up is also pretty dull, that gap is dicey and possibly it is susceptible to a reversal. So, if at all, there are many more people who are eager to buy like you and they are indeed buying, the volume should have gone up. The open interest should have gone up. If it is not, there are a lot of people being skeptical and saying, hey, I'm going to pass this opportunity. Let the parade pass me by. I don't want to take chances. All right. Now, solution number 6. If at all you are to buy the stock on a gap up, do remember at that point in time, the stock should be trading above its 25-day exponential moving average. Remember, I have told you that the 25 EMA is a proxy for 1 month long holding on cost of a bull. And as long as the price is above the 1 month long holding on cost, the bulls are happy. If the price is below that 25 EMA, the bulls are jittery. So if you're buying on a gap up, make sure that the price is above its 25-day exponential moving average. And if you're short selling, make sure that the price is trading below its 25-day exponential moving average. And even if the condition is met, after you enter, this situation reverses, please exit, because the reason for you to having entered into that trade has reversed. Next solution, even if you enter into a trade based on a gap up, please exit intraday itself. Why? Because the next day could be a reversal of this day. And then you'll get trapped if you leave your position open and roll it over to the next trading session. So gap days are purely for intraday trade, even if you're entering them in the conditions of all these criteria being met. Even then, exit on the same day. And last but not the least, even if your conditions are met and you're entering the trade Please trade on very small volumes because these are high volatility days and the price can cut you both ways. So, in case something goes wrong, you lose less. In case something goes right, you make less. But then do remember that the gap has already eaten into a certain portion of your average true range or the ATR. Friends, there are many more challenges that traders face on a day-to-day basis, and I'm going to be making videos to help you a lot to become much better traders, and this channel is made for your benefit. Before I say goodbye in this video, I'd like to remind you to like this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. In the comment section, good, bad or ugly, please let me know what you think about this video. Also, help me reach out to smart traders like yourselves by referring my video to your family and friends. Thank you for your patience and sticking around in this video till we meet again in my next. This is Vijay Bambani signing off for now. Take care. Have a very profitable day. Bye-bye.